Hi guys, it's MJ, and in this video I want to talk about liquidity risk and give you some sort of introduction to one of the most popular risks that a majority of businesses have to face. So, how can we think of liquidity risk? I want to draw two diagrams for you, and then we're going to chat about them. So this diagram represents time, and this is positive amounts, and that is negative amounts. And now how business works is that you go along and you make some money at various times by selling goods, rendering your services, all those type of things. So this is money coming into your business. But running a business also means you have to pay your staff and you have to pay your rent, and maybe there's a disaster, and you have to make various payments to other people, and these are known as cash outflows. So we have cash outflows and we have cash inflows. Now, when it comes to, say, what is the profitability of a company, profitability is if the inflows are greater than the outflows. Okay, but liquidity risk looks at something a little different. Liquidity risk kind of says, well, let's look at these cash flows here. Let's have this as the amount of cash in the business, and this is time. We start with some cash on hand. When money comes in, it goes up. Then when money goes out, it goes down, and it does something like this, so this is how your cash balance changes and all these type of things. Liquidity risk is if the following happens, is if our outflows is more than the cash on hand at any given time. So if our outflows at any given time is greater than the cash on hand. Okay, this is very big trouble. Think of it as a car running out of fuel. It can bring a business to a halt. It could put the business into a thing known as liquidation, where the assets are sold off in order to pay the creditors. So it's very, very dangerous if a company's outflows are greater than the cash on hand. So what some businesses try to do is they try to keep cash on hand. So what they'll do is they'll have, say, R1,000,000 in their assets, but they'll keep, say, 100,000 Rand just in the bank in case the outflows, or they miss an inflow and the outflows are more than expected, they can at least meet them. And this is sometimes known as their nest egg, or it's a little bit of an insurance against liquidity risk. The problem with having a lot of cash on hand is that it dilutes your returns. So having too much cash on hand dilutes your returns. So what that means is that your money is not working for you. Remember, your business is taking money, putting it into economic use, and getting quite a high return. If you have some of that money just sitting around, it's not being worked, and there's this massive opportunity cost. So of your money not being at work. So even if you are like a Bill Gates or a massive company that has lots and lots and lots of money, it's not the wisest to have too much cash on hand. And this is one thing where enterprise risk actuaries can help to optimize the situation. By what is the minimum amount of cash you need to have on hand in order to be protected against liquidity risk? That's one of the big questions consulting actuaries try to answer. And one of the things that we do is we look at alternative strategies. Okay, other strategies for dealing with liquidity risk is the two main ones are a bank overdraft facility and trade agreements. So bank overdraft is, let's say I'm a little business and I want to maximize my return. So I want to put all my money into my business, all my money into working assets. Great. I set up an agreement with the bank that says, if I ever have a big outflow, you guys will let me take an emergency loan to pay off that outflow so that my business can continue going well. You guys know that you'll get your money back because my business is sustainable, it's profitable, and I'll pay you back a nice interest rate. Trade agreements are kind of the same. You say to your supplier or whoever you're doing business with, thanks so much for your goods. I'm going to only pay for it in 90 days' time. and we're going to do this because we have this trusting relationship, and they will maybe allow to it. The problem with both banking overdraft and trade agreements is that they do cost money. So banking overdraft, I mean, you are going to have to pay a return or an interest rate on that. Trade agreements, you might have to give them some sort of discount to allow them to do that. So they're not a silver bullet. And remember, the reason why we don't want to hold cash on hand is because it's going to dilute our returns. If we introduce another expense, that's going to dilute our returns. So it's up to the actuary or the very intelligent management to try and optimize what is the best way to protect against liquidity risk. Sometimes these strategies are not available to the businesses. Say, for example, Northern Rock. Okay, they sponsored Newcastle in the English Premier League, and they were a bank that pretty much stuffed up. So we had the world recession, they had all these mortgages, they couldn't repay the loans on time, they didn't have enough liquidity. Now, Northern Rock are a big bank. They can't go to another bank and say, hey, we need a couple of $100 million in an overdraft facility. Other banks are going to be like, whoa, that's not cool. They can't do the trade agreement because it's with so many other counterparties that it's not going to work with. So what Northern Rock was forced to do was to go to the central bank, or the bank of last resort. However, when that news came out, it caused a lot of panic, and everybody who had deposits in Northern Rock were queuing and queuing to try and withdraw their money, which put further liquidity strains on them, and it kind of just stuffed up Northern Rock. So liquidity risk is huge. I mean, because Northern Rock might have been able to say they didn't have to pay the amount right then and then, they might have made money in the future, and then everything might have been hunky-dory. But liquidity risk calls them to not be as solid as a rock. But now, liquidity risk, again, it's very difficult to try and model this. I mean, the quantitative approaches do break down because, like we've seen with all the other risks, data is limited. Okay, and not only is data limited, but the situations are not homogeneous. What that means is that most of the time, the situations are unique. You know, Northern Rock's situation is unique compared to, say, a logistic company, or to, say, Charlie's Bakery down the road, or something like that. You know, there is a unique situation when it comes to liquidity. Each company will have its own unique cash outflow model. So it is something that you have to do one at a time. One way to look at these things is through a technique known as scenario analysis. And what you do with scenario analysis, you say, okay, let's look at each of these cash flows. What is the probability that we get it? What is the amount going to be? How confident are we going to do it? Are there going to be any sort of delays? And we're going to do this type of analysis on each of the cash flows, the inflows and the outflows. And then we're going to have some scenario analysis. We're going to say, well, what happens if we miss two of our inflows? How does that hurt our position? What happens if this position over here is delayed till over there? Are we still going to be good because we've got a massive outflow over here? And you can actually start tweaking and trying to predict the inflows and outflows, trying to handle the uncertainty. And it is quite a challenging thing. It is something that you need to be quite qualified to do, because you do have all these interaction of risks. For instance, if interest rates rise, it might cause some assets to fail, some things to become more backdated. And what you can do at the extreme level of scenario testing is stress testing, which is when you wipe out most of your inflows and say, well, can we deal with it? Or what will our crisis management plan be? Maybe if you're a small enough company, you can have some sort of banking overdraft facility. But liquidity, it's another risk that you have to look at on its own, just like how we saw with operational risk. Anyway, how much time are we going into this video? This video is at 9 minutes. I'm thinking, should I talk more about liquidity risk, or should I make another video? Let me make another video on liquidity risk. It will be a follow-on for this, so make sure you check that one out. Thanks, guys, so much for watching, and I'll see you back here tomorrow.